Good day, class. Welcome to the third session. In this session, we will briefly investigate various aspects of cost and revenue. Healthy service providers carefully manage the use of scarce resources while meeting a growing demand for services and the rising expectations for quality. In order to increase a manager's understanding of the factors that affect resource use, staffing pattern, service mix, service practices, and procurement, one needs to conduct cost and revenue analysis. The information acquired from the analysis helps managers consider different means of producing services in order to reduce cost and increase revenues. Conducting a cost and revenue analysis is very useful, especially to organizations that are trying to meet major challenges like expanding existing services, integrating new services, or working toward financial sustainability. Managers need to determine what actions to take in order to ensure financial sustainability in the future for the organization. By analyzing costs involved in providing services and the flow and sources of revenues, helps managers make better decisions concerning the optimal use of resources and means to recover the costs. Managers used to conduct costs and revenue analysis on paper spreadsheets in which data was entered and tabulated manually before the use of computers. But now we use electronic spreadsheet tools which make cost and revenue analysis faster and simpler. Electronic spreadsheets retabulate new input data automatically, making it easy to project future costs and revenue scenarios, which allow managers to consider the possible impact of making changes, such as adding new services, creating new facilities, or changing staff utilization. Managers can use electronic spreadsheets to look at both the clinical and the financial factors that affect cost recovery and financial sustainability. It is crucial to bear in mind that the information provided by a cost and revenue analysis is only one aspect of strategic planning. There are other factors that also need to be taken into account. Managers should consider the findings from a cost and revenue analysis along with other factors when making decisions. Cost and revenue analysis provide you with financial and operational information needed for making good management decisions. It helps you take a closer look at the efficiency of your existing programs and identity changes to improve cost efficiency and explore the potential impact of the decisions made by management. Cost, revenue, and profit are crucial parts of the financial analysis of a business, and it is on the comparison of these three factors that success is judged. Costs are either fixed or variable costs. Fixed costs are the cost of the business that are incurred and have to be paid regardless of the volume produced or sold. For instance, rent and insurance. Variable costs are directly linked to the task, so they change according to the level of output. For instance, the raw material that goes into making a product. Adding fixed costs and variable costs gives you total costs. Revenue is the total amount of money coming into a business from sales of goods and services. It is the top line figure from which costs are deducted to determine net income. Profit is the bottom line, the result of deducting costs from total revenue. Gross profit is profit before the deduction of expenses, and net profit is the profit after all expenses have been paid. There are a number of calculations or ratios that can be used to analyze the relationship between costs, revenue, and profit. You get the profit margin by dividing the profit figure by the revenue figure, which lets you see how well the company controls its costs to turn revenue into profit. Let us briefly look at three methods of production: job production, batch production, and flow production. Job production is when companies use all the factors of production to complete one job at a time. This will usually happen where products are all unique or they are being produced on a very small scale. Batch production is when one operation is completed on a number of units of the product before they are then passed on to the next stage of the process. Flow production is when production takes place as a continuous process. The production flows from one place onto the next. This will usually happen where the product is standardized and can be made using a production line method. There are two forms of production techniques: labor-intensive and capital-intensive. Labor-intensive is when the proportion of labor used in producing the product is relatively high. Labor will usually be used instead of capital. Capital-intensive is when techniques are used to produce items that use relatively more capital than labor. Many industries are now like this, including car and steel industries. There are a number of factors that contribute to the technique you choose, such as the size of the company, the cost of factors of production, and the product. During production, a firm incurs a number of costs, which are either categorized as fixed costs or variable costs. Fixed costs are the expenses that do not change according to the level of production. For example, rent. Variable costs are the costs that change according to the output produced. For example, raw materials, labor costs, and energy costs. It is important for a company to stay efficient by keeping a careful eye on how their costs compare, which can be done by looking at the level of average cost. The calculation for the average cost is total cost divided by the output. This gives you the cost per unit produced. Another way of monitoring efficiency is labor productivity, which is calculated by dividing the output by the number of employees. There is a cost of running a business, which is calculated as an hourly cost. In order to run your business, you need to know this information to understand where your break-even cost is going to be. The formula for calculating your hourly cost is the sum of your pay, your overheads, and your profit margin divided by your working hours. Your pay is the hourly cost you pay yourself for running the business, or what you would pay an employee to do your job. This can be based on industry standards or on what you made at your previous place of employment. Overhead is the amount needed to keep your business functioning properly, which could include the cost of utilities, taxes, insurance, maintenance, fuel, internet access, and any other expense for items which are used on a near daily basis to maintain your operation. Profit margins are the amount above basic operation costs to build revenue. The formula for calculating the profit margin is dividing the net income by the net sales revenue. We have come to an end of our third session. Please go over your learner guide to look at topics you might have missed and to look at the provided examples. Let us take a break and continue with the last session.